Thank you for listening to the Tortoise and the Hare Financial Podcast. The first 3 months of 2022 in the markets have been very volatile. So in this episode, I am providing you with a summary of what's happened in the markets, both in North America and globally as well. I hope you enjoy. Thank you for joining me. This is the TvH Financial Q1 Market Update. My name is Jim Leo. I'm partner at TvH Group, president of TvH Financial, and private wealth advisor at Raintree Financial Solutions. U.S., Canadian, and global equities ended Q1 positively, posting gains in March, but for the overall quarter, markets were mixed. Geopolitical tensions, rising oil prices, high inflation, supply chain disruptions, and central bank policy weighed on the S&P 500 Index, Nasdaq, Dow Jones, MSCI EAFE Index, and global indexes. The energy-rich TSX Composite Index, on the other hand, benefited from the market turbulence. In bond markets, U.S. and Canadian yields rose on inflation news and expectations of larger rate hikes by the Fed and Bank of Canada. The yield curve continued flattening throughout Q1, reflecting tighter Fed interest rate policy and forecasts for slower economic growth. Following the trucker protests that started in January, Alberta, Saskatchewan, Manitoba, Ontario, and Quebec announced the immediate ending or speeding up of the lifting of COVID-19 restrictions. Major corporations started scaling back COVID-19 restrictions as well. National Bank, CIBC, and Scotiabank revealed plans to start bringing staff back to Canadian offices. Deloitte became the first major corporation to end its mandatory vaccination policy and masking of employees in Canadian offices. In March, Canada and the UK began talks on creating a comprehensive free trade agreement. Representatives from both governments stated they were committed to concluding negotiations relatively quickly and having an agreed-upon plan in place soon. U.S. inflation climbed to 7.9%. A 40-year high, driven by supply chain disruptions, labor shortages, and rising energy, food, and housing costs. Inflation is also expected to increase further due to the Russian-Ukraine conflict. Fed Chair Powell said inflation is much too high and a severe threat. He noted as the U.S. economy no longer required pandemic-related emergency stimulus, it might be appropriate to raise rates more aggressively to get inflation under control. The Fed hiked rates from near 0 to 0.25% in March, its first increase in 3 years, as well as signaled 6 more hikes by year-end. Powell stated the Fed was ready to make a 0.5% hike if required. In Canada, inflation surged to 5.7%, its highest level since 1991, and the 11th consecutive month above the Bank of Canada's 1-3% target range. According to Statistics Canada, prices rose across all major components, with housing costs contributing the most. In March, just before the Fed, the Bank of Canada raised rates 0.25% to 0.5% for the first time since the pandemic began. Bank of Canada Governor McClem said the economy was now ready to adjust to a normal, higher interest rate setting. So let's talk about the capital markets in Q1. The S&P TSX Composite Index ended the quarter up 3.8%, while the S&P 500 Index posted a loss of negative 4.6%, and the MSCI EAFE Index a loss of negative 6.8%. Geopolitical tensions, rising oil prices, high inflation, supply chain chaos, and central bank policy weighed on the S&P 500 Index and the MSCI EAFE Index. The energy-rich TSX Composite Index, on the other hand, benefited from the market turbulence. In bond markets where yields move in the opposite direction to prices, short-term yields rose quicker than long-term yields on expectations larger rate hikes are coming. The yield curve, which is the difference between 10-year and 2-year U.S. Treasury yields, also continued to flatten throughout Q1 as short and long yields have been converging. This reflects tighter Fed interest rate policy at the short end and forecasts for softer economic growth at the longer end. In foreign exchange markets, the Canadian loonie lived up to its reputation as a petrodollar, increasing to 80 cents against the US dollar off the back of rising energy prices. Bitcoin moved with mainstream markets but with more extreme swings. The leading cryptocurrency halved in value early in January, compounded by events in Kazakhstan, although it had started to recover by quarter end. Oil prices, which surged during 2021 as a result of ongoing supply chain chaos and are currently a thorn in the side of inflation, were pressured further after Russia invaded Ukraine. In February, the price of oil broke through the US $100 a barrel range for the first time since 2014. It then skyrocketed to US $110 a barrel in March, before falling at quarter end on news the US would release 1 million barrels of oil reserves a day over the next 6 months to help ease prices. So what can we expect? After a stressful start to 2022, there were signs in March that markets are rebounding. More rate hikes are coming to combat inflation, which will likely remain high in Q2, but should cool later in the year as supply chains normalize, prices ease, and hopefully peace is restored in Ukraine. After the record-breaking double-digit returns of 2021, it's inevitable the pace of growth will be slower this year. However, economic fundamentals and corporate earnings remain healthy, and the post-pandemic recovery continues. Regardless of where we are in the market cycle, it's important to take a disciplined approach to investing and stay focused on your long-term financial goals. This strategy helps you keep your emotions out of investing, typically buying high and selling low like many investors do. We recommend you maintain a diversified mix of asset classes in your portfolio to maximize potential returns and minimize risk. Regularly reviewing and rebalancing your portfolio back to the target asset mix we created also ensures it remains aligned with your goals. Thank you for your continued trust in me and my team for the opportunity to assist you in working toward your financial goals. We are with you every step of your investment journey, identifying strategies and opportunities, reviewing performance, and rebalancing your portfolio to keep you on track. Should you have any questions regarding your portfolio, please do not hesitate to contact my office. Thank you and take care.